Hi, I'm David Schenck. I'm an attorney and enrolled agent, enrolled to practice before the IRS, and I talk about tax issues, estate planning, and asset protection. Today we're going to talk about the IRS Collection Financial Standards. So what are the Collection Financial Standards? The IRS runs a number of different programs for taxpayers who are unable to pay their tax debt. For example, currently not collectible status. If the IRS determines that you are unable to make payments on your tax debt while also providing for the basic living expenses of yourself and your family, currently not collectible status basically says that they will not attempt to collect from you because you're unable to make payments and provide basic living expenses. Or the Offer in Compromise program, which is a formal offer to the IRS to settle your tax debt for less than the full amount, which the IRS will only accept if you demonstrate that your offer is as much as you can afford to pay. So how do they determine how much you can afford? As you might imagine, for these and similar programs, the IRS has standards for what constitutes allowable expenses. And they only allow you to spend up to a certain amount for various expenses. And anything that you spend over that amount is disallowed. And the IRS expects you to lower that expense and pay them the difference. So let's look at some of these standards. Some of the standards are national. And this means that everyone in the entire country gets the same allowance. Even though, of course, these expenses do vary from place to place. The national standards are for food, clothing, cleaning supplies, personal care, and miscellaneous expenses, and out-of-pocket health expenses. Other standards are local or regional, and these include housing and transportation. And household size counts too. So when they're considering the allowable expenses for either the national or local standards, they're also going to take the size of your household into account. Here you see a list of national standards, and as you can see, food, housekeeping supplies, apparel and services, personal care products and services, and miscellaneous. And as you can see, for a household of one person, they're allowing $841 for those various items. For a household of two people, $1,389, which is not twice $841. And as you can see, they go up to four people, and then they have a list where if you have more than four people, each additional person gets $356 allowance additional. And they're talking about dependents when they talk about people in your household. These standards don't require any documentation. You don't have to prove that you spent $466 on food or $47 on housekeeping supplies, etc. If you spend less than this, you don't have to report to them that you spent less than that. And if you're spending more, you're going to need to justify it, not just demonstrate that you are in fact spending more, but justify that it is necessary for some good reason. And there's one more national standard, which is out-of-pocket health care, and it's split up by age. If you're under 65, they allow you $79 a month for out-of-pocket health care. And if you're 65 and older, $154 a month. And these, as with the others, do not have to justify if you're spending that amount or less, but you do need to justify if you're spending more than that amount. And then there are local standards for housing and transportation. We're going to look at a couple of different metro areas because obviously they vary from area to area. Here we have housing expenses for a couple of counties in Ohio. As you can see, they're roughly the same. $1,395 for a family of one in Adams County, and $1,442 in Athens County. As you can see, they go up to about $2,000 for a family of 5. Note that these are for rent or mortgage and utilities. It's not rent or mortgage alone. And here is Kings County, New York, which is Brooklyn. And as you can see, in Kings County, it's quite a bit higher, $3,114 for a family of 1 and up to $4,367 for a family of 5. But you can see that other counties in New York are not much different than the counties we looked at in Ohio. Transportation is also local. Sort of. So as you can see here, you have a national amount for public transportation of $218 a month. And then you have car ownership cost, that's also national, of $629 a month for 1 car, or $1,258 a month for 2 cars. And you'll note the list includes 2 cars. Single taxpayers are usually only going to be allowed 1 car, and 2 cars is for married taxpayers. You'll also note that there is both car ownership and public transportation. You can claim both if you can justify the need for both. For ownership expenses, the taxpayer is allowed the lesser of the standard shown, or the actual loan or lease payment. If there's no loan or lease payment, $0 is allowed. If your loan or lease payment is greater than the standard shown, you're going to have to justify why it's necessary. And while ownership costs are national, operating costs are regional, and sometimes local. And these operating expenses include pretty much everything: fuel, insurance, maintenance, parking, tolls, registration fees, etc. So here you can see the Northeast regional operating costs. And in the entire Northeast region, you've got $298 a month for 1 car. But if you live in Boston, it's only $294. You lose $4. Whereas if you live in New York City, you get $379. And if you live in Philadelphia, $318. And other regions are similar in that they have a regional cost, and then where they have expensive metropolitan areas, they're going to have different local costs. But these standards aren't completely inflexible. If you're spending more than the standards, all is not lost. But you need to be able to demonstrate a genuine need for the extra expense. Things that might qualify would include special medical or educational requirements for you or a family member. And things that won't qualify include anything that looks like a luxury or an extra expense without some genuine necessary justification. Now, the standards that we just covered aren't particularly generous, but they aren't especially drastic either. And they apply when you go to the IRS and you're trying to work something out, when you're trying to fit yourself within one of their programs. If they come to you looking to collect, if they're levying or garnishing, trying to collect, they can be much, much tougher. And this is a chart of garnishment amounts. And here, what you're seeing down at the bottom, which is the easiest one I think to look at, the monthly amount for a person, single taxpayer with no dependents, is $1,154.17. And that's not how much they're going to take. That's how much they will leave. So if you make $1,154.17 a month, they won't take a nickel. But if you make $2,154.17, they'll take $1,000. And if you make $5,154.17, they're going to take $4,000. And as you can see, if you look to the right, if you have numbers of dependents, they allow more for each number of dependent. Works out to about $391.67 per month that they will leave you in your paycheck for each dependent. So while the figures for the collection financial standards are not particularly generous, they are nowhere near as brutal as what happens if they have to come to you and start garnishing your paycheck, which is very, very painful. If the IRS is levying your assets or garnishing your wages, and whether it's your bank account or your retirement account or your house or your car or your Social Security check or your paycheck or any other asset, there are steps that you can take, and please note that I have individual videos on each of these programs. One thing you can do is you can pay off the debt if you can. If you have the money or can get the money, paying the debt in full is going to stop all levies and garnishments, and the IRS will also lift any liens that they file. And this is obviously the simplest way to stop IRS collection activity. You can also try to file a collections due process appeal if you're within the appeals window. It's an internal IRS appeals process, but it's only going to be available to you fairly early in the process. Once they're coming to seize your assets, probably too late for you to get into the collections due process appeal. But they will pause any collection activities while your appeal is working its way through the process. You can also set up an installment agreement. Once you establish an installment agreement, they're going to stop all collections activities. However, any liens that they filed are going to remain in place until the installment agreement is paid in full. You can also ask for currently not collectible status. If you can demonstrate to the IRS that you can't pay your basic living expenses while making payments on your tax debt, they may put you on currently not collectible status, and they will stop attempting any collections activities. But be aware, as we just discussed earlier, the IRS ideas of how much you need for your basic living expenses can be quite low. You can also file an offer in compromise application. An offer in compromise is a formal offer to the Internal Revenue Service to settle your tax debt for less than the full amount. And they will stop all collections activities while they are considering your offer in compromise application. And this can be anywhere from a few months up to as much as 2 years. You can also file for bankruptcy. When you file for bankruptcy, something called an automatic stay stops all of your creditors, including the IRS, from any collections activities at all. And if you have a substantial amount of non-tax debt, if you owe to people who are not the IRS, bankruptcy might be a good option. But be aware that not all taxes are dischargeable in bankruptcy, and it can be a little tricky to figure out which ones are dischargeable. And I have a video on that very topic. If all or most of your debt is taxes, an offer in compromise is certainly a better place to start in many cases. You may also file for innocent spouse relief if your situation qualifies. If you are or might be an innocent spouse, the IRS is going to cease collections actions while they consider your application. Finally, you can check if you are approaching the 10-year statute of limitations. The IRS doesn't have forever to collect on unpaid taxes. They have generally a 10-year statute of limitations. And you might just be able to wait them out if you're approaching that 10-year statute of limitations. However, be aware that it can be a little tricky to determine exactly when the statute of limitations date is going to pass, because there are a lot of situations that can toll the running of the 10-year limit or suspend that limit so that it takes longer than 10 years to reach the 10-year statute of limitations. And again, I have videos on all of these if you are interested or want to get more information about it. Disclaimer: this video and any accompanying text is for informational purposes only. The information provided does not and is not intended to constitute legal advice. No attorney-client or similar relationship is formed. If you require legal advice, please contact an attorney or other legal professional. This video covers a complex legal area in just a few minutes, and of necessity leaves out much of the detail. Don't make decisions based only on this video.